Hello friends and partners, this is Pankaj Tibrewal from Kotak Mutual Fund. Today I am going to talk to you all about Kotak Emerging Equity Fund. Kotak Emerging Equity Fund is a fund which invests in mid and small cap stock. The basic approach of the fund has been bottom up stock picking, and we believe that the basic investment philosophy of the fund is to invest in capital efficient business model, to look out for niche and competent managements, to look out for companies which are operating in scalable businesses and which are available at a reasonable and attractive price. We believe that the fund is diversified with about 50 to 60 stocks, and we look out for companies which over a period can be compounding stories. We believe, easier said than done, that out of the 5,000 listed companies in India, you have to find that 50-60 companies which keep on compounding our wealth over a period of time. But it's not so difficult as well, because if we follow the basic investment principle of investing in capital efficient business models which are run by competent people, the task becomes much and much easier. The average ROE of the fund over the last couple of years has been more than 15-16%, which we believe is a basic ingredient for investing in companies in India. The fund consistently has been able to outperform the benchmark, and we believe that's the basic tenet of any fund from a mutual fund staple. The fund is suited for investors who are looking for extra return than a pure large cap or a pure diversified or a multi-cap equity fund. We believe mid and small cap funds come with an inherent risk that should not be ignored, but over the life cycle of the funds, once say 1 year, 3 year, 5 year, 10 year, the extra return compensates for the risk you are taking in the fund. We believe that mid caps, though in the near term the headline valuations look rich, but the space is very diversified, the space is very large, and if you focus on stock specific opportunities, then the money is to be made and the wealth is to be created. In the near term, though the mid and small caps look rich compared to large caps, but we believe that as the economy is recovering, the best suited play to play this economic recovery lies in the mid and small cap stocks, because those are the companies which are more linked to domestic economy. Hence, in Kotak Emerging Equity, around 85% of the portfolio is linked to domestic oriented businesses, and less than 14-15% of the businesses are global in nature, because we believe that the global environment is not conducive, slower growth is going to stay, and hence global facing businesses will continue to face challenges. The equity positioning today is consumer discretionary overweight, financial savings as a theme overweight, industrials and cement overweight. The underweight stance continues to be on IT, metals, real estate, telecom, etc. In the near term, we believe that the 7th Pay Commission will act as the main catalyst for consumer discretionary, mainly auto anks, consumer durables, white goods, so and so forth. On the industrial and cement sector, we are excited by the public sector capex pickup, mainly on the roads, railways, defense, etc. Though we acknowledge that the private sector capex is still some time away, but any sector which is linked more to production, an increase in capacity utilization is likely to benefit in the near term. Hence, we are overweight on cement, we are overweight on bearings, we are overweight on pumps, etc. The third theme, that is a multi-year theme, is a shift from physical savings to financial savings, and hence we are very positive on private sector oriented banks and private sector oriented NBFCs. The underweight stance on IT continues. We believe that the business is going through a transition from typical application development maintenance to digital, and a lot of companies are facing challenges in this transition. In metal sector, we fundamentally believe that there is nothing changed on the demand supply equation, and hence we continue to be underweight on that sector. The portfolio is more growth oriented, as we believe over the last 7 to 10 months, the market is moving more from high quality, which is as represented by high free cash, high cash flow, to more growth at reasonable price, which means that any company which demonstrates high quality but has no growth has underperformed over the last 7-10 months, but companies which demonstrate high quality characteristic and also has growth is clearly the winner. And we believe market is intoxicated with growth. There are certain pockets which are showing growth momentum in this economy as well and handsomely rewarded by the market participants. Our view is that over the next 12 to 18 months, a lot of niche businesses will see momentum gaining back either on the top line or in forms of margin and flowing down to the bottom line. And hence, it will be a stock picker's delight. The fund is clearly positioned to ride this recovery wave, and hence we believe this fund is ideally suited for investors which have a longer term or a longer horizon of investment of say 3 to 5 years and can bear the extra amount of volatility in the shorter term than a pure diversified or a multi-cap investors. Thank you all.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.